So before we kick off on talking about U.S. exports, we want to talk about OPEC, what's happening with OPEC at this point, and then what do we think is going to happen going forward. But before we get into that, I got a great question on Twitter just now, and I just wanted to highlight it, where they came out and said, look, Refinitiv is now showing too much oil in storage in Asia. And, why do you think that's the case? Because as we said, and we'll talk about it, later on as well, you had obviously Typhoon Shanthu come through. Vessels had to move, but then obviously they come back, they get calculated as floating storage. But now people are seeing that the pendulum has swung too high to the other side, and that's really driven by electricity issues. And electricity issues are forcing run cuts on the industrial side, but more importantly at the refining side, petchem side, and then at the port. So now you're seeing port congestion that was already bad getting worse. So some of these builds that are happening offshore is just going to be, it's going to be less about the fact that there's not enough storage onshore or there's not enough demand. It's just you're going to see a lot of noise now, just given that the electricity shortfalls, some of these rolling cuts. And that's a big thing we're going to talk about in segment 5 of the Econ show tomorrow. So that's something that, again, we'll bring back into focus when we're talking about some of these different areas. So now this is always a very contested chart when we look about OPEC spare production capacity. And I know everybody's going to have their own number. I tend to think that this is closer to correct than further away. And the reason why is because there has been investment. Again, an NOC has to tell you nothing. It's a national oil company. They don't have to tell anyone anything they don't want them to know. So when you look at Iraq, Saudi Arabia, Kuwait, UAE, we have seen a decent amount over the last 3 years of investment. Where we haven't seen that investment is on the Nigeria-Angola side. So there is some reduction in spare capacity. So, could Nigeria get back to 2 million barrels a day? Probably not. Could it get to 1.7? Yes. But again, that delta is going to be a bigger issue. But at the same time, they produce a lot of condensate, which is a bit easier to recover. So you could say maybe there's some swing capacity in that. Angola's been on a very steady decline. They need additional investment, but a lot of the finds have been more on the natural gas and natural gas liquid side, not on the oil side. But remember, as we've been saying, the pivot is very much into petchem. As I gave a presentation yesterday, when you look at just where the demand is, it is petchem. 16% of Chinese demand now is natural gas liquids, and over the last few facilities to come online are not naphtha but propane and ethane based, which again is going to support some of that NGL move. So here's where we sit on the spare capacity. If you want to say it is closer to 6 million versus where they're calling it out at 8.5. Again, this is all up for debate, but we do know that there is spare capacity sitting there, which leads us into what is OPEC going to do. Now, given where crude future pricing is at 75.12 WTI, 78.81 Brent, you could say that, look, they're going to increase cuts. They're going to increase production. But realistically, when you look at the physical market, there's really no reason to increase cuts, which maybe this is going to be bullish for futures, but they're just going to continue to that 400,000 barrel a day increase is, I think, going to be very stable in October. And any issue that I think we were talking about, that they were going to get cautious in October and start to see some adjustments in November, but IDA took 30 million barrels a day out of the market. So you had IDA providing some of that support. You have the backdrop in terms of some of the strength that has now opened up into the U.S., offsetting some of that east of Suez softness, specifically Asia. So when you look at China. So when you look at some of the shifts, you have to say, okay, well, right now you have West Africa that has cut OSPs, and you've started to see some tightening, even though, again, as we've said many, many times, OSPs is a starting point. Nothing says that you can't trade above or below the official selling price. It's just that's where you start. And if the market is loose, then you'll go below it. If the market is tight, you go above it. But you're starting to see more aggressive cuts with the new expectation for Saudi Aramco is to lower their selling price of Arab light crude by 40 cents a barrel month on month for November sales to Asia, which again would go from $1.30 premium of Oman, Dubai, compared with $1.70. So again, you're starting to see the competition. We've seen it in Iraq, we've seen it in Dubai, we've seen it in Murbain. And again, that's where these friction points, that's where you continue to see it as WTI and Brent is well bid above where both West Africa and Middle Eastern crudes are trading, which is going to say, well, if I'm selling physical for declining prices, well, I'm not going to really be in a position, or would I really want to increase production? Plus, think about where they are right now. They're coming into the end of the electricity necessary in terms of that burn. So they're going to have more exports regardless, just based on the time of year. So you're already going to increase exports without increasing production any additional. So again, I think this kicks any real talk into November, and they'll be able to keep things, I think, fairly stable as we go into the October 4th meeting. Now, one of the things that keeps coming back up, so Libya's gone back and forth. They're trying to find some sort of stability. General Haftar has now put himself in the running to be president with the expected December, I think it's the first or second week of December, is supposed to be the election. And realistically, they're trying to promote new investment from U.S. entities into Libya because, and you might say, why would anybody invest in Libya given their past, their history? And realistically, it's a country coming out of kind of the throes of civil war. You have individuals that want to get back to a certain amount of normalcy. A lot of the extremism, again, this is a loaded statement, but a lot of the extremism has been removed, or at least has been addressed accordingly, providing a decent broad move of safe zones. And it is very different versus Afghanistan, where Afghanistan there wasn't this drive to kind of come back out of where they currently were, where in Libya there's a little bit of a different view internally between the different tribes, and at the same time it's a lot of easy oil. And I obviously oil production, oil exploration, none of it is actually easy, but when you consider just how much meat is still on the bone in Libya in terms of the conventional drilling, where there's opportunity, how much growth can come in there. And it's not going to come overnight. This isn't like they're going to go from producing 1.7 million to 5 million in a year, but there is a lot of steady growth that can really, and I think low cost growth, when you look at trying to manage on a major side, on an NOC side, trying to manage your decline curve at a company level, this provides a lot of that opportunity. So again, that still provides some of that growth, and not to ignore the implications that we're talking about. But here's when you look at Libya's volatile crude output. That drop is when we had that additional fighting, when you had Haftar blockading. That has now ended, and they should be now at about 1.3 million barrels a day, 1.27, which then puts about 1.17 million barrels a day into the export market, which has kept pressure on not only just WTI, but also Urals going into the Mediterranean and Europe in general. So then when you look at, well, what are some of the positive points coming into this? And it's really going to be, what is the cheapest way to heat your home and produce electricity? And this is when we start looking at natural gas, coal, fuel oil, gas oil. So in the U.S., we have taken down a lot of abilities to go from gas to coal. So we're really going to be beholden to gas regardless. We can keep, the coal facilities operating 24 hours a day, but there's really not mothballed coal that we can bring back because a lot of that has been torn down or is already in the process of being torn down. And then fuel oil, gas oil, we don't really have that capacity. But when you look at the EU, something similar, natural gas is very expensive, but coal is there. It's competitive in aggregate. When you look at all of these on the same playing field, coal is going to make more sense versus other. And even fuel oil, if you don't have coal, maybe you'll start using fuel oil. But that comes into a much bigger issue of you have to pay carbon taxes on that. And is it worth paying the carbon tax on fuel oil versus maybe a coal facility where you have a scrubber? Then you look at Asia, where you have some of the similar cost issues with the EU, but you have coal as the answer. Australia has a lot of that available. So does Russia. And if you look at some of the capacity, it's just, what are you going to, do you have the facilities available where fuel oil is a bit more available? We've seen that in Pakistan. We've seen that in Bangladesh. And that's something that we think we're going to continue to see adopted over the coming months, is additional fuel oil consumption in Asia more than anywhere else. Now, it'll increase in Latin America, especially in Brazil, but Brazil can produce a lot of their own. So that will just take down some of their crude exports. They'll consume more internally, increase run rates, and then use that fuel oil to essentially power some of the shortfalls that they have on the hydroelectric and biomass side, given some of the sugar issues. So that's where we're going to see some of this competition, and it'll be something to watch. But again, it's going to create some of that competition in general. Now, one key fact when we look at the U.S. in general going into the winter months, heating oil is essentially diesel at this point. And in some places it is diesel, and it's equivalent to road diesel. So not only are you going to have an increase in demand internally, for the residential side, but you also have demand going into trucking, and then you may have more demand going into the global market. So that's going to create, again, that pricing metric where we will see distillate be a strong driver going forward and support some of the heavier barrels, which, again, coming back to imports into the U.S. So now getting into the export picture, as we were saying last week, we expected a bit of a makeup number because we had the Houston Ship Channel. They had issues with Nicholas in terms of inbound, outbound vessels. You had some of those shifts in general. Now you have a bit of the makeup. So gasoline had an increase of 104,000 barrels a day, right in line with the 5-year average, even though distillate had an increase of 341,000 barrels a day, still well below the 5-year average, and that will drop back down. Now, gasoline, we expect to see a little bit of a kind of a bumping along, but as we go forward, we think that you're going to have distillates kind of continue to struggle. Then on the propylene side, LPG, again, some of that makeup, you had vessels that were carrying gasoline, distillate, crude going through, not so much LPG. That will flip, and you'll see some of that support. And then when you look at crude oil, had an increase of 211,000 barrels a day, going just above 3 million again. But we still think that, again, there's going to be that drop back to and within that range of 2.6 to 2.8 million. So Europe imports of clean petroleum product from East Asia this month may climb to the highest since October. And cargoes already arrived total 400,000 tons, and the full month could be as high as 480,000 tons. Some of that will slip into October, which is already putting October on a strong footing, especially when you look at what's going into Europe. And imports of clean petroleum product of East Asia, when you look at what's going to come at this point, arrivals in October could be even higher. 4 tankers hauling about 320,000 tons are currently signaling Europe next, but again, we're still in September, so it's a matter of what's going to be signaled in general. August arrivals were at 360,000. We think that we're going to easily take over that 360. But the reason why we talk about this right now is because this is typically where the U.S. sends products. So we're still getting more from Asia, more from the Middle East. That is going to impact just where our exports are and leaving some of that in the system. But look at the distillate storage. Well, why would you export it given where some of the spreads are, given where we are on a storage side versus export it? So again, there's going to be some of those impacts in general. And then on the crude side, again, why do we think we could see some of these pressure points? And the spread between WTI and Dubai is back to $4. And if you look historically, that's just why am I going to buy WTI when I can buy Dubai, Murbain, other Middle Eastern crudes that either price off of Dubai or some blend, where again, this is where you're seeing some of it, but you still have that East Asian slowdown, which East of Suez slowdown, which is going to keep, again, that WTI fairly tight on that export level. And then the same can be said for Brent, where it's back to just about $4, and that's, you're starting to see some reduction in loadings as we go into October into November, but it's still going to be elevated. You're still going to see an increase in floating storage as they try to compete. They have stopped trying to move pricing down right now. I think they're trying to figure out where pricing is going to look. Because remember, as we come into the end of the month, typically the market tries to test where's the right level. So over the last few months, we've had Urals spike in terms of what the offers are. Bids are. We've had offers. The CPC, something similar, where it's going from 275 minus dated Brent to $1.60 minus dated Brent, and then trying to work its way back to see where's that clearing price. Has it gotten any better? Has it gotten any worse? And so we expect to see something similar as we go into the first 2 weeks of October. Now, when we look at gasoline exports here, you can see we're right at the 5-year average, even though we had that increase. We do expect to see some increase, again, along the seasonal norm. It's just we don't expect to see a huge shift, especially because obviously prices are still strong in the U.S. Can I sell it in the U.S.? But do I have the ethanol? RINs are expensive. So it's not as a simple question, because if I export it, I don't have to worry about RINs. So that could be some offset to try to protect against the EPA regulations. But again, we just think it'll be right now along that seasonal norm. Distillate had a spike, still well off the seasonal average. We just think it'll continue to go sideways, either fall within the cloud or just below, but again, still not reaching back to that 5-year average as we have more competition coming into our market. Now, ethane exports remain elevated when you average things out. And as we've talked about, and for clients, I'll have the chart in there on Friday, looking at how much new capacity in China is ethane propane based, and how that's going to be supportive for U.S. ethane prices, as we've been talking about. For those that have been listening to us rant on a regular basis, for those that read our insights, we have been very bullish. Liquids pricing, that still hasn't shifted at this point in time. And then when you look at crude oil, exports, again, just a bit more of a sideways move, as we've been talking about. And as we look at the 4-week rolling average, which is currently at 2.7, again, right on one, we'll get a little bit of an increase, but it's still going to be fairly capped within this structure. And when you look at the electricity issues, so now we turn to Asia, they're having electricity issues. Latin America's having issues. Europe, as we all know, continues to have issues, which is going to impact industrial demand. It's going to impact, how much are people willing to leave their homes if they're concerned about, well, am I going to go somewhere and not have electricity? It is, and the uncertainty just freezes people. And that's what I don't think the market is appreciating when you look at on the industrial side and on the consumer side, the uncertainty or the anger or the frustration of not having power or the cost of power is going to keep people essentially capped and say, well, I don't know what my electricity bill is going to be. So do I really want to go travel somewhere and go and stay at that hotel, 2 hours away? Or am I going to kick that to the right? And again, there's a lot of this uncertainty as inflation goes up. And again, electricity prices is easily helping the inflation argument. A lot of these pressure points are just hitting people's wallets and their ability to spend on a daily basis. And then when you look at propylene demand, exports, that they had a drop. Again, it's still going to stay either seasonally adjusted all-time high or just at the top of the cloud as the demand continues to be strong. As we were saying with ARA, it's going to be lumpy. You had now the drop down. It's seasonally adjusted back to the lows. We just expect it to stay below the 5-year average, but be fairly lumpy as we go forward, just given where refiners are doing, how much crude are they purchasing, and where are we seeing some of these shifts. So now when we turn to activity in the ARA, so gasoline had a build of 56 tons up to 813,000. So when you look at gas oil had a draw of 119,000. it's just, I'm sorry, 119. And then when you look at just where their builds are, they're still, when you look at the backdrop, it's in a fairly bullish spot, which is why the ARB is wide open, bringing product from Asia, from the Middle East into Europe. And that's something where we're starting to see refiners creep back to life. Spreads are getting a little bit better, which again is going to be supportive. But what does a refiner consume but electricity? So even though you should see this activity, how much of that is going to be pressured by their cost going up, because they are big consumers of electricity? That again is going to be that bigger overhang. But regardless, this is still a bullish backdrop from the gas oil side. Now, when you shift to gasoline, we were saying we expected it to get back to the 5-year average. The 5-year average will the 15-year average works in our favor, just because you can see it gradually moves down. And that's where we were saying just the comps got easier. We still expect to see a fairly decent flow from Europe into the U.S. at the pace we're seeing right now. We don't see it increasing or decreasing right now, just very stable, very consistent. And they do have then they're trying to arbitrage gasoline from the Middle East versus the U.S. So there's also some spread to be captured as fuel oil continues to build, which this is going to be one to watch. Do they export this and try to capture some of the margin in the emerging markets in Africa? What are some of the backdrops that can be generated just because people will be using more generators? People will be using this to generate electricity. So that this could provide some arbitrage opportunity, or if it doesn't, some recracking into products that can be used within Asia. Within Europe. Now, when we look at flows, October, we've had Russia have a big step up. They've increased Ural loadings. We've seen a decrease of refinery activity, which has put more on the water. And you can see that right now, this is about the same level that they were at back in June. So again, a lot coming out. You have Norway still at those, even seasonally adjusted, but at the highs that they've had because of Johan. And then when you look at Nigeria's taken their exports back up in November. And then when you look at Angola has dropped their exports from October and November. And right now their exports are much closer to what they were in September. So not too much has changed, as the North Sea stays very strong going into November. And when you look at the UK, something similar. So again, everything coming out of the North Sea and Europe still remains elevated in general. Now looking at pricing, so we had CPC blend sell at 260 less dated Brent. That was recent, that weakens from $1.75 less dated Brent. Some West African differentials have been gaining over the past week from recent lows. And again, they went really low. So to see them come back up, it's still below the OSP, but again, it's still strengthening, which is just they reached that point of that clearing price, and a lot of that is actually the US at this point, and some Europe. So then Saudi Aramco may reduce the official selling price, as we had mentioned earlier. And then when you look at Ghana's Jubilee for October loading, sold at a premium of about 50 cents per dated Brent. So again, some of that movement that continues. Then we had Urals and CPC trading at a fairly steady clip, at the differentials that we've been talking about. We haven't seen too much movement. There hasn't been a lot of activity on the Platts window. And I think it's people waiting for, as we're in September 29th, what does October look like? How does that set up? We normally kind of get that spike, as we were saying, in the first 2 weeks. So I think everyone's trying to play it easy to see what that opportunities could open up. How many cargoes they just want to clear that are left over from September that have bled over into October. How much is potentially bleeding from October into November that they can pick up at a bit of a discount. And Nigeria is going to boost crude and condensate exports to that 1.53 million per day. Angola revised up after 3 cargoes were added. And then when you look at, there was an issued tender to sell a Congo cargo, as Congo, again, kind of continues to show some of that softness in general. So realistically, there's not much change. Things have essentially stayed fairly steady. ESPO still has a fairly strong bid to it. Not much has crossed, and you're just starting to see a bit more barrels come out of the Middle East and really compete, as Libya has, remember, as we talked last week, Nigeria slashed OSPs. Libya did the same thing. Iraq did the same thing. So there's a lot of competition, because at this point they might say, look, let's bring prices down, see if we can create some competition and try to drive up some of this opportunity. Now, on the Fujairah side, you can see total oil products were reported at 15.53 million, rebounding from their recorded lowest levels last week. And then when you look at the total stock rose 535,000 barrels, which is up 3.6%. Light distillate had a build of 154,000 barrels to about 5.11. Regional demand was seen picking up with increased demand from Pakistan, which again, we're starting to see some of those flows into the emerging markets as they get past COVID, but also they try to start to prepare for what is that winter month going to look like and where's pricing. So you're starting to see some of that slow improvement on the spot tender side. And then India starting to see a little bit of increase in that gasoline above even where it was, which was bullish. But again, diesel and distillate still remain in the doldrums. And a lot of that, some of that is done by the monsoons, and then some of that is just done based on economic prowess or slowdown or lack thereof, if you will. Stocks of middle distillate rose 637,000 barrels, or 20.8%, up to about 3.7 million barrels. The gas oil complex east of Suez remained backwardated, just given the tight supply and expectations of that demand, as we've been talking about on the electrical side. So that's going to be something to watch, because remember, middle distillate and heavy distillate are going to be the ones to kind of gauge how much of this is going to be absorbed into the electricity market or power generation market. Heavy resid fell 256,000 barrels to about 6.7 in the bunker market. In Fujairah, the market remained buoyant, just given the amount of trade that's coming through, which, as we've been saying, still remains the case. And high sulfur fuel oil market is still faring better. And the reason why is when you look at just high sulfur fuel oil, it's the cheapest. This is some of these emerging markets are going to pull this down versus trying to take some of that low sulfur and ultra low sulfur fuel oil. So again, those are going to be some key things to pay attention to. Now, when we look at what happened in Singapore, you had a drop of 46.1 million to 45.4, and that was really driven based on light distillate. And as we've been saying, light distillate had a big run up. Then you start to get some of this normalcy. And as we've been showing with the Singapore stocks, we expect it to just go sideways, because you do have slowing demand. You do have an increase in exports, especially from China, which is going to offset, because as they export more, then others are just going to try to be advantageous, maybe buy Chinese cargoes, export their own, or just consume more and lower run rates, and just try to, again, manage what storage looks like. So this is why we continue to see Singapore totals going sideways. And it's just going to be what is driving it. So light distillates has been a gradual move up. Again, we expect it just to continue to move sideways, as gasoline demand still remains an overhang in some of the Southeast Asian and Chinese markets, where middle distillate, we expect it to stay below that 15-year average, but again, moving sideways, because you're still going to have that increased demand, but you're going to have that supply response. And then we'll talk about how some of the crack spreads for refiners have improved a bit in Asia, which again is going to incentivize some additional movements. So when we look at global crude oil on the water, you had a little bit of a drop. You had some of that movement get caught up after the typhoon has moved through. So crude oil in general, again, 5-year average, we expect it to continue to move along the 5-year average. And we should actually get a decent kind of jump, if you will, when you look at what's happening in Asia, as additional cargoes get slated again for floating storage. And then you have the issues of power and offloading. So oil in transit is back to the 5-year average. So when you look at day rates have gotten a little bit better, which just means that there's going to be additional cargoes on the water. So we continue to see this moving in along that 5-year average. And remember, crude oil in transit, you have less, even though if you have production that's been reduced, you're going to have more exports, keeping things fairly firm. Here's where floating storage starting to recover. That's going to continue. It should get back to really the peak before we had some of the hiccups from the hurricane side. So I should say hurricane and typhoons. So that's going to be fairly gradual as we go forward. And then when you look at time spreads have come down a bit. But when you look at Brent, we're getting close to a roll. So that's going to adjust a bit. But again, still seeing some strength, which is promoting some of that flat pricing that we've been talking about and seeing through the front of the curve with December versus December continuing to be strong. And it's the strongest for Brent. So WTI has been at this level. Brent continues to strengthen, which again is keeping it priced out of some of the market as they've tried to cut some of the pricing on the back end on the physical side to try to offset. But the view is that it's going to be a strong, not only just December, December in general with that bigger recovery. So then when we start looking at spreads from the refining side, here you can see that there's been a fairly steady increase in that hydrocracking. And then when you look at what's happening on that light hydrocracking, you're continuing to see some of this growth where the FCC side is starting to get a little bit tighter. So again, promoting a bit more activity, starting to see a little bit of that opening up. Still net negative, but again, you're starting to get much closer to that flat pricing. Now, there's still that underlying cost in terms of what is fixed versus variable. And this is where you can get into a lot of fun discussions, especially for those that enjoy refining as much as I do. But you should start to see a little bit more of a pickup as we go forward, as we get some of that bleed up on the hydrocracking refinery margin. And again, we've seen some discounts coming across on the OSP side. You've seen some of those benefits coming through in general. Because remember, a cut for an OSP, it goes right down to the refiner. So by cutting these down, you open up some additional capacity for refiners to increase runs. And then when we look at Northwest Europe, firmly above zero, negative, you're starting to see a lot of growth, especially on the hydrocracking side, on the Urals. And it's really Ural pricing has come down, has come under pressure. They've increased loadings of Urals, so the increased volume also putting pressure on pricing, but enabling them to some of the margins. But again, they also consume electricity. Electricity prices have gotten a little bit stronger in Europe, which again is going to weigh against some of these underlying margins that isn't really captured as well here. In the Mediterranean, even though we have two net, it's still positive. You're still going to see some of that activity. It's just going to be a matter of what can be consumed, where Libya has increased, staying fairly strong. At about 1.17 million barrels a day. Urals have increased their capacity. CPC remains available. So again, you're seeing some of this pushback that is keeping activity fairly strong. And then China's supertanker imports, we think it's just going to continue to move sideways as we do have some additional cargoes leaving the West Africa and heading for the Chinese markets. On the flip side, when you look at run rates, now this is even before some of the bigger announcements on cuts. So here you can see Shandong independent refiners, or teapots, is back down to 2018 levels. And there's going to be more downside pressure as they've just announced that they're going to have to reduce some of the electricity consumption, which will impact some of those run rates even further. And again, that's going to be something as they continue to fall well below 2020, and I think are going to just continue to move along the 2018, 2019 lines. Asia floating storage starting to recover. Again, we expect it to continue to come all the way back up, driven based on the typhoon has passed. You're now recognized as the longer you sit as storage, and then you have those issues at the port with the electricity side. North Sea, seasonally adjusted, all-time high. We just expect it to not continue up, but now go sideways. It's just, as we were saying, issue with pricing, competition has increased, and there is just more being produced in the North Sea, which is also putting more in floating, which will then go from floating into onshore, especially when we start looking at maybe some potential purchases within Europe. West Africa still remains above the 5-year average. We think it's going to stay above the 5-year average, even though we are seeing some additional movement in Nigeria from all of West African nations, some into Asia, some into the US and Europe. There's still a lot of cargoes available. And now that they've taken up their expectations and their production, or I should say loadings, for November, that's going to again leave more in the water again. Now, Middle East is the one that we've been talking about as to watch, and you can see that it keeps creeping higher on floating storage. Prices have actually tightened in the Middle East, which again is indicative of a bit more that's being used for floating storage. A bit less boats are available because they're getting there and being used for floating storage on the other side. So this is going to be, again, as this creeps above, because we do think it goes back to the highs of 2021, that's going to be something to watch. And that's another reason why we think, as Saudi Arabia will make that OSP cut to try to accelerate some of the purchases coming out of the nation and the region. And then Europe, as we've been saying, sideways, the comps got easier. We continue to think it's going to stay at that 5-year average as Shandong cooled off a bit, but we do see refinery throughput cutting down, which is going to leave more crude in the system. But we do see some of that additional fuel oil getting pulled out as they try to make way for and feed down into the system, just given the shortfalls that are going to be there because they're going to produce less because the electricity shortfalls, the run cuts that they're going to have to make in due time because of it. So that's our show for today. If you have any questions, you can find me on Twitter. You can happy to talk in the comments section. But otherwise, we hope you have a great day. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.